Learn how to get started in the most profitable industry in the world and start seeing returns like this, maybe this, and even this. So let's start from the basics. What is Forex trading? Forex trading is pretty much simply the foreign exchange market. It is a market where in the world that we live in, there's all these different countries. All these different countries have their own currencies. All these different currencies have their own value. And when one country does trade with another, there's some type of foreign exchange transaction. Now, what most people don't understand is you can actually make money off of exchanging one currency for another currency when one is stronger or weaker than the other. So in the world we live in, everyone's heard of the stock market. The stock market is a multi-billion-dollar daily industry, but the foreign exchange market dwarfs the stock market. It's a $7 trillion a day industry, meaning it's a lot more volatile. There's a lot more movements. There's a lot more opportunities to make money, and it's 24 hours a day, 5 days a week, compared to just, the NYSE 9 to 5. When it comes down to what you're actually buying or selling, when it comes down to Forex trading, you're not physically buying any specific currency pair. You're not buying euros or USD. It doesn't work that way. When you're buying and selling in Forex, you're not actually physically owning anything. There's no tangible asset that you have. It's not like, oh, I'm buying a bucket of GBP, right? Or, oh, I'm getting a pound of US dollars. See, that doesn't make sense. In currency trading, you're simply betting on whether the digital value of a currency is either rising or falling, and you're making money as long as you're betting in the correct direction, right? So prime example is, let's say Euro USD, you think it's going up. In that specific model, you think that the euro is gaining strength over the dollar. Let's say in retrospect of that example, let's say you want to sell Euro USD. If you're selling the euro versus the dollar, you're expecting the US dollar to gain more strength over the euro, and that's how price works, right? It's all based off of what currency pair is stronger or weaker, and then from there, you just have to be in the correct direction. You guys might see on social media, on YouTube videos, Instagram, whatever it might be, you always see these charts, and you see GBP, JPY, Euro USD, XAU USD, all these different currency pairs. Now, what really is a currency pair? A currency pair is just two sets of currencies that are trading against one another, and that's something that you can take advantage in. When it comes down to how you actually learn how to take trades on currency pairs, it's mostly 90 to 95% technical analysis. We'll talk about technicals later down the video, but technical analysis simply just means the way that the charts are moving, the price action, and how the market goes up and down, and it's consistently moving. On top of this, currency pairs are, living, breathing, moving things. So each different currency pair has its own specific personality. It has its own time of the day it's active. It has its own time of the day where maybe price doesn't move as much. Think of it as like a human being. You know what time your best friend is active, maybe their work schedule, when they're relaxing, they're not really doing too much. Think of that and put that in the perspective of the market. When the market is volatile in the currency pairs that you like after you study them. When the market is consolidating or it's a little bit slow. When to stay away from it. When to participate in the market. Now, when it comes down to your currency pairs, you're going to find a few different currency pairs based on your personality, based on your own risk style, and based on, your own trading strategy that you're going to fall in love with. And if you focus on those specific currency pairs, you can start seeing the results that you want to see. So the beautiful thing about Forex trading, like we mentioned earlier, is Forex trading is 24 hours a day, 5 days a week. Now, there's times of the days where you don't want to get caught in the market, and there's times in the days where you definitely want to participate in. Now, the most volatile pair is the New York session. The New York session is when the New York Stock Exchange opens up. The USA is just waking up. Everyone's working. The economy's thriving. Everything's booming. So this is the time of the day where when you're trading pairs that correlate with USD, you're probably going to find the best possible setups. Knowing your sessions is very important because there's other sessions as well, like Asia, Sydney, so on and so forth, Frankfurt. But in regards to it, a lot of these sessions are just consolidation sessions. And, when you're trading Forex, you want to catch a big move. You want an expansion. You want a distribution. So trading in the most volatile time sessions and market sessions is the best for your entries and exits in the market. So now, what is a long versus a short? You're going to hear people in this trading industry talking about, hey, I'm going long Euro USD at 1.5001. You're going to hear people say, hey, I'm going short on GBP USD at 1.8, blah, blah, blah. Now, when it comes down to it, long and short simply just mean buy and sell. If someone says that they're longing a currency pair, that means that they're simply buying the Euro USD. They're simply saying that they expect the euro to have more strength than the US dollar at that specific time, at that specific move. If someone is saying they're going short, short simply means that they are selling the market. They're going short as the market goes down per tick, per point, per pip, they're going to be making money going short. The beautiful thing about Forex trading is you're not physically buying a tangible asset or a stock or a commodity or, any of those things. You're simply betting on technical analysis, price either going up or going down. And as long as you're trading in the right direction, long, buy, sell, short, you're going to be able to make some type of money. Now, what is a pip? Now, this is something that's so simple and also something that people just have a hard time grasping for some reason. A pip is simply a unit of measurement when it comes down to Forex trading. Think about you using a ruler at home to measure things out, or a yardstick, or whatever unit of measurement you use wherever you are in the world. In the Forex market, a pip is a percentage in point. It tells you the difference in each point that the market is moving. So when it comes down to it, we have tools like TradingView that help us calculate the pips and tell us exactly how much pips that a specific move can potentially give us a reward of, and how many pips potentially the risk might be. Now, you make money per pip the market goes in your favor, and you also go into drawdown, or potentially when you close your position, lose money when the market goes against your direction per pip. When it comes down to Forex trading specifically, you're gonna need a good broker. And I'll tell you guys this, we've tried almost 20 different brokers. Any broker that you could think of, we've tried. There's only one that we really trust and that we use on a day-to-day consistent basis, and it's going to be in the link in the bio. Go check it out. This is one of the only Forex brokers that we trust right now in this space. So there's two types of analysis when it comes down to Forex trading. There is the technical analysis, and then there's the fundamental analysis. Now, technical analysis simply means learning how to draw on the charts, mark up areas of supply and demand, support and resistance, use tools like the Fibonacci retracement, and so many more. Technical analysis is plain and simple, just learning how to read what price is showing you through the candlesticks. Now, fundamental analysis is based off of major news events, things that are happening in the geopolitical world, things that are happening in Congress and politics. And trading fundamental analysis is something that you can follow with simple websites like forexfactory.com. Now, when it comes down to it, I would say in regards to Forex trading is about 90 to 95% just straight technical analysis. Now, I've been trading for 8+ years. In the sense of fundamentals, I look at red folders on Forex Factory that tell me about high impact currency pair news, but at the end of the day, I don't focus on fundamentals blindly. I feel like some people just say that they trade fundamentals, and that becomes a whole concept that even though I do not understand and participate in it all in, I know people make money with it and everything like that. But what I can tell you is that I've seen a huge amount of success just off of technical analysis. And 9 times out of 10, if your technical analysis is strong, usually the fundamental analysis kind of flows with the market, either gets you to an entry or continues your position in the direction that it's going in. So when it comes down to it, once again, there's 2 types of analysis, technicals and fundamentals. You as a Forex trader, I'm going to keep it a stack with you guys. You want to focus on technical analysis, grasp technical analysis, and be aware of fundamental analysis. Now, guys, we all see these bars on the graph. You've seen your friends post these charts on social media, Facebook, Instagram, whatever it might be. I mean, you're on this YouTube video right now, so you're obviously interested in trading Forex. Forex trading is based off of technical analysis. Technical analysis is based off of reading charts or the bars on the graph. These bars on the graph are called candlesticks. More specifically, they're called Japanese candlesticks. All these Japanese candlesticks do is they just give you a visual representation of how price is moving. Now, what that really means is a candlestick shows you the highest and the lowest point that the market went within that specific time frame. When it comes down to Forex trading, there's so many different time frames, and for each time frame, there's a different candlestick that shows you how much price moved on that specific 1 minute, 5, 15, 1 hour, 4 hour, etc. So what a Japanese candlestick does is it shows you the highest point and the lowest point of a candle. It shows you the open and the closure of that candle. Based on a few different candlesticks correlating together, you can start identifying candlestick patterns, rejection patterns, and when you start correlating these specific candlesticks and the momentum and the aggressiveness behind them with your technical analysis and the strategies that you're going to learn and develop from our channel, you can start creating a model or a strategy that you could make a few $1,000s a week, sometimes even a month off of. Little to no time that you're dedicating to the skill set. So what is a lot size? Now, when we're entering in the Forex market, it's not like the stock market. You're not buying 100 shares of Apple or 1,000 shares of Microsoft, and you're not buying 100 shares of GBP USD, or you're not selling 1,000 shares of Euro USD. It doesn't work like that. A lot size is your position size when you're entering the market. Your lot is going to depict how much you're going to make per pip, or how much you're going to be in drawdown or lose per pip. You pick your lot size, and that's why risk management when it comes down to Forex trading is so important. Because if you use too big of a lot size, you can potentially affect your account in a negative outcome. And sometimes maybe you can get lucky, and if you use too big of a lot size and price goes in your favor, you can have a big win. Now, when it comes down to it, position sizing or lot size calculation is super important. And that's why we like to use the Nash Markets app to calculate lot size. You just simply plug in your entry, TP, stop, your balance, how much you want to risk, and it does all the calculations for you, and it tells you how much you're going to risk, what percentage, and it even gives you the lot size. So go ahead and download that. It's on the Apple App Store and the Google Play Store, absolutely free. That is going to be the Nash Markets app. We use that for lot size calculating. It helps you super fast, super convenient, right on your phone. It's a great tool to add to the arsenal. But to spin it all back, your lot size is just how you enter the market, how aggressive or how, conservative you're placing your trades or your bets in the market. So what is leverage? A cool thing about Forex trading, which is a little bit bittersweet, is the fact that we get to trade with leverage. Because we're trading with these online Forex brokers, these brokers offer us different size leverage to trade in these markets. The leverage is pretty much borrowing money from the bank, the broker, borrowing money from someone, in this simple example, it's borrowing money so you can use a bigger lot size. Some brokers offer 1 to 20, 1 to 50 leverage. Some brokers offer 1 to 100, 1 to 500, so high and so more. What does leverage really do for you? Well, 1 to 100 leverage means that per $1 that you deposit in your account, the broker is matching it or giving you $100 worth of buying power for that $1. So what does that mean? It means that you, even though you have a $100 account or a $1,000 account, even though it's not a lot of money, they're actually fronting you or letting you borrow a large amount of money. And what does that allow you to do? It allows you to risk more or place a bigger lot size, which either could help you if you're in the right direction, make a lot of money, or it could bite you in the butt and you could blow your account. So that's why, with TradeStar, we don't recommend using anything more than 1 to 100 or 1 to 200, just because at the end of the day, you don't want to get too pumped up or too excited and then end up blowing your account over literally nothing. So leverage can be your best friend or it could be your worst enemy. And that's why position sizing and risk is so important when it comes down to leveraging as well. So we like to correlate all those things together. What is margin? So margin correlates just with leverage. When you're borrowing money with leverage, you're also having a margin where you can get margin called, aka the broker will close out of your trades in a loss so you don't lose more money, or neither do they. Margin is simply the risk based on the lot size you're using on your account. AKA, if you use too big of a lot and you start going into drawdown, you have a specific percentage of margin on your account. If you hit 50, 60, 70% margin on your account, the broker may automatically start closing your positions just because you're in too much drawdown and they don't want to lose too much money and they don't want you to lose either. So they try to protect your account. But in reality, it's a terrible feeling to see your screen turn red and you start hitting margin calls. So when it comes down to entering in the market, there's a few different ways you can actually enter a position into the market. Obviously we buy and sell, but there's 5 different type of market orders that you can have or you can participate when it comes down to the market. The first one is being a market execution or an instant execution. What does that mean? A market execution simply means that wherever price is at that specific moment, you are entering right there at that specific price point, right on the same second that you click the buy or the sell button. For majority of traders, they're doing instant execution or market execution trades. They're finding their setup and then right there on the spot, a volatile market that we mentioned, or maybe they're trading New York session, another volatile market that we mentioned, and they find a setup and they're buying on the spot or they're selling on the spot. That's a market execution. Now, after that, there's 4 different types of pending orders. A pending order is very simply put, it's a trade that you set up for the future. Now, what that simply means is that you're expecting price to get to a certain level, maybe a high point to sell or a low point to buy, and you're setting up a pending order or a future trade or a trade that activates once market hits your overall area where you want to sell. So example, a buy limit. Wherever price is at right now, it's an order you place below price. And if price comes and tags your buy limit, that's where it's going to enter you into the market. And as price goes in your favor, you'll make money per pip based on the lot size that you're putting. A sell limit is the exact opposite. A sell limit is an order that you place above the current market price, and if price comes to that sell limit and triggers it, it gets you into the trade, and then as it goes down, price will go into your favor and you can make money. And then there's two stop orders. There's a buy stop and a sell stop. A buy stop goes above market price. Once it triggers the buy stop, you think that price is going to continue to go up and it just takes you on higher. And then sell stop, you put that below price. Once that hits your entry, it enters you into a sell right then and there. And then as the market goes down, you'll continue to make money per pip based on the lot size that you're putting into the market. So those are going to be the different market orders that we have. So quick recap, we have instant execution, market execution, a buy limit, sell stop, buy stop. 5 orders. You know, you're going to find out as a trader who you are and what you like more. Me personally, I like to do a lot of limit orders. After limit orders, I like to do some market execution, but I never really do buy stops and sell stops. But I know a lot of friends that are amazing traders that buy stop and sell stop and they go crazy with it. It's all about figuring out your personality and getting in tune with that. What is a Forex broker? We mentioned the broker that we use a little bit earlier down in the link in the bio, but when it comes down to a Forex broker is simply the middleman that connects you to the bank, connects you to the liquidity provider so you can actually place trades. Think about back in the day, you would see people calling in to a liquidity provider or a bank to say, hey, I want to put this trade in, I want to put this order in, blah, blah, blah. Instead of doing that, the Forex broker, what they do is they give you direct access to liquidity through them as a middleman, and they charge you a small commission and a spread markup on every trade you take, and that's how they make their money, by connecting you to the LP or connecting you to the market so you can actually take your trades. When you hit a withdrawal, the broker is the one that's taking the money from the live market and giving you the money that you just withdrew and sending it off to you. And when you deposit into a Forex broker, you're putting the money into the Forex broker and they're putting that to work while you take your positions in the live market. When it comes down to it, Forex broker, simply put, is the middleman. If you want to trade Forex at a retail level, you're going to need some type of broker to execute the trades for you. You know, we talked about the Nash Markets app earlier, just as one of the tools we like to use to help our lives become easier. Another tool we like to use is TradingView. You can go to tradingview.com, download it on your phone, iPad, laptop, whatever. TradingView is where we're going to be analyzing the market and marking up our charts, doing our technical analysis. 2 other apps you could download is MetaTrader 4 or MetaTrader 5. They're both on the App Store, Google Play Store. You can download it on your desktop as well. That's going to be your terminal where you're actually going to be executing the Forex trades. There's other terminals you can use, but by far, 7-8+ years that we've been trading in this specific niche, I've used MetaTrader 4 and MetaTrader 5 for, the last almost a decade. There's no better platform than MetaTrader for executing your trades. So analyze on TradingView and then, place the trades on your phone really quick or place them on the desktop. Super, super simple. So guys, when it comes down to it, one of the biggest things about Forex trading, it's not about the charts, your strategy, who you follow, who your mentor is, whatever, methodology or strategy you follow or believe in. What matters most is your psychology. Forex is the lowest entry and highest reward business in the entire world, but it's also the hardest industry to become successful in. The statistic says that like 90 to 95% of people who trade Forex, they're not going to see results, not in their first few weeks, not in their first few months, some not even in their first few years. And the reason why is you have to develop a certain level of mindset and psychology to win in this market. Every time you step foot on a chart, it is a physical battle that is happening. Whether it's a mental battle, whether it's a technical battle, there's a battle that is happening. So you have to understand that you as a human being, you have emotional, and human beings are emotional about a few things. Some of you are emotional about friends and family. Some of y'all are emotional about your materialistic things. And some of y'all are emotional about your money. Now, when it comes down to Forex trading, what we do is we manage risk. Now, think with me really quick. What does that mean, manage risk? Managing risk simply means that you are risking money for the potential of a reward of a greater X factor of money. So you have to have a strong psychology, because what happens? Hey, maybe you have 2 or 3 winners in a row. Now you're feeling like a god. You're like, oh, who gonna stop me? Wrong mindset. Maybe you're on a losing streak. You've lost 1, 2, 3, 4 trades in a row. You're down 4%, 5%. You're down 10K. You're down this, blah, blah, blah. That could really affect your mindset and your psychology in a negative way. Forex trading is way bigger than just these charts and strategies and studying. It's about you growing as a person, you developing yourself, you personally developing, and also building a mindset and a very disciplined psychology of how you approach these markets. You need to have a very mechanical, disciplined approach, and that's the type of approach we teach at TradeStar Strategies.